In the early 2000s, America seemed to be in the midst of an economic renaissance. Cities bustled with construction, businesses thrived, and families believed in the promise of the American dream. Homeownership had become more than just shelter. It was an investment, a status symbol, a measure of success. Banks, seeing opportunity, extended mortgages with unprecedented leniency. People who would previously have been denied loans, those with low credit scores, limited income, or unstable employment, were now approved. These were subprime mortgages, high-risk loans packaged as a path to financial security. Borrowers assumed that rising home prices would shield them from any risk. For a time, it seemed the system worked flawlessly. Housing prices climbed, banks profited, and investors around the globe eagerly purchased mortgage-backed securities, believing them to be stable, low-risk assets. Rating agencies reinforced this perception, often giving the highest safety ratings to instruments that were anything but secure. Underneath the surface, however, fragility was accumulating. Lenders were making assumptions that home prices would never fall. Borrowers were taking on debt beyond their means. Financial institutions created increasingly complex instruments like collateralized debt obligations, or CDOs, which were bundles of mortgage-backed securities sliced into tranches, each carrying different levels of risk and reward. These products were bought and sold internationally. Investors, even sophisticated hedge funds and pension funds, often did not fully understand the risk they were taking. The entire system became a delicate house of cards, held together by confidence, assumptions, and the belief that housing prices would always rise. By 2007, the first signs of trouble appeared. Housing prices stalled, then declined. Borrowers with adjustable-rate mortgages faced steep payment increases they could not afford. Foreclosures began to rise, and the value of mortgage-backed securities fell sharply. Banks, insurers, and investment firms that had invested heavily in these instruments faced mounting losses. The financial system, once thought stable, began to tremble. Lending froze, businesses could not secure credit, and consumers struggled to finance purchases. Fear began to ripple through markets, investors began selling assets, and the first waves of panic swept across the economy. Human stories illustrate the crisis vividly. In Phoenix, a young couple who had refinanced their mortgage multiple times now faced foreclosure after losing their jobs. Their house, once considered an investment, was now worth far less than they owed. In Florida, a retired teacher watched her savings and pension evaporate as financial products tied to the housing market collapsed. In Ohio, small business owners closed their shops after credit lines vanished. Across the country, millions of ordinary Americans confronted uncertainty, stress, and loss. By March 2008, Bear Stearns, a century-old investment bank, collapsed due to a liquidity crisis. The Federal Reserve intervened, facilitating its takeover to prevent systemic collapse. But the warning signs were clear: the financial system was fragile. By September, Lehman Brothers, another major investment bank, declared bankruptcy, sending shockwaves through global markets. Stock prices plummeted. Banks teetered on the edge of collapse. Investors panicked. Worldwide, markets reacted violently, from London to Tokyo, from emerging markets in Asia to European economies tied to US financial instruments. Insurance giant AIG faced near collapse because of its exposure to credit default swaps, financial contracts meant to insure against the default of mortgage-backed securities. Had AIG failed, it would have triggered a global financial catastrophe. Governments moved decisively, injecting billions in emergency loans and guarantees. The US Federal Reserve cut interest rates to near zero and coordinated actions with central banks worldwide. Stimulus packages aimed to support households, stabilize businesses, and prevent a depression. The human impact was staggering. Millions lost jobs, homes, and life savings. Foreclosures rose. Retirees saw their pensions decimated. Students struggled to pay tuition. Communities faced unprecedented stress. Cities like Detroit were filled with abandoned homes. Construction projects halted in Spain and other European nations, and markets across Asia lost billions overnight. The crisis demonstrated the interconnectedness of global finance and the vulnerability of a system built on debt, speculation, and unchecked optimism. The causes were systemic. Banks over-leveraged themselves to maximize profit. Regulators failed to enforce oversight. Rating agencies misrepresented risk. Borrowers overextended themselves, encouraged by easy credit. Complex financial instruments like mortgage-backed securities, collateralized debt obligations, and credit default swaps obscured risk, creating a network of hidden vulnerabilities. The combination of greed, ignorance, and systemic weaknesses resulted in a collapse of unprecedented scale. Governments and central banks responded to prevent total economic collapse. Emergency liquidity programs, bank bailouts, and stimulus measures were implemented worldwide. Regulations, such as the Dodd-Frank Act in the US, were enacted to prevent future crises, increase transparency, and reduce systemic risk. Globally, financial systems were restructured, stress tests became standard, and oversight of banks improved significantly. The 2008 crisis reshaped economies and financial thinking. It emphasized the importance of financial literacy, savings, diversification, and cautious investment. Individuals learned hard lessons about risk and debt. Policymakers learned the dangers of unregulated financial innovation and interconnected markets. The crash highlighted human behavior, greed, fear, and misplaced confidence as a powerful force capable of destabilizing entire economies. Even today, the 2008 economic crisis serves as a cautionary tale. It reminds us that prosperity built on fragile foundations can collapse suddenly. It teaches the value of preparedness, prudent decision-making, and understanding financial systems. It is a story of numbers, but also of people, families, workers, investors, and nations, all grappling with uncertainty, loss, and the challenges of recovery. It is a story that continues to influence economic policy, investment strategies, and personal finance education, underscoring the fragility of financial stability and the importance of vigilance, foresight, and resilience.